Hi traders, welcome back to Pure Technicals. Today, rather than looking at a actual trading strategy, we're going to look into more on the trade management and risk management strategies. Now this particular one is called the pyramiding technique, and it basically allows you to, once you've caught a trend, you caught the bottom of a trend or a retrace of a trend, it allows you to open multiple positions with minimal risk. You could have up to 5 positions, the risk would only actually be that of 1 position. I'm just going to state before we start, this trend was not your usual 5-wave trend. This was a trend that happened last year, and it followed on all the way into June this year, May-June time period, where it started to reverse. Now, even though this isn't your normal trend, the trade management strategy stays exactly the same, and it goes like this. If you had seen this trend line break back here and you started looking into buying, you probably wouldn't have caught it down here at the absolute low. You probably would have had more of a chance of catching here. If you had used Fibonacci, you would have seen this as a 38% retrace. You may have bought here. Now if you buy here on this retrace, you've got these signals here, you've got the pin bar, you've got 2 inside bars that follow and then the break above. That would have been your buy signal. So you would have bought there on the break above here. Your stop loss, of course, would have been placed below the low of the inside bar down here. Now as the price moves up, you've got entry here, stop loss down here, and you wouldn't put in a take profit target. Instead you would wait for price to move up, and then you'd get a reversal pattern here for retraces. You see the retrace was only tiny, but you still get a retrace. Now you had a reversal bar and a retrace. Once you got to this retrace and you got a sign that the trend was going to continue, you had a few little signs in here. You had a pin bar here, you had a pin bar here, inside bar, and then you had the buy up, and you also had a very slight rising triangle. So once you had the buy signal and that was confirmed, it would have been confirmed on a break above this, being the triangle. You would have rebought, and when you bought, you would have taken your stop loss from your original position and put it at break even. So now, even if the price comes back down, you've only got the risk of this one trade, but you have 2 trades open. So now we can see you buy down here. The move from your entry to where price next started to retrace was 317 points, which is huge. You'd already have that, and now your original buy stop loss is at break even, so that trade there has absolutely no risk attached to it whatsoever. When you traded this signal here, your stop loss would have been down here, below the pin bars, below any sign of support. So on the break of this level when you bought, your stop loss would have been down here. Let's work out what that is in points. Okay, so you're risking 130 points. Now as you can see, price does break up, it moves up again, and the next reversal pattern you actually get is all the way up here, this inside bar. You would have held on again, because you know this is a very strong uptrend. You would have held on until the uptrend is absolutely broken, and you can see it didn't. We had this engulfing bar, which was a continuation pattern. So once the price got up to this level, when you saw this reversal, your stop loss from your original buy, you would now put up to here, and that would be just to be safe. Realistically, once you saw this engulfing bar pattern and you saw price break higher, you would actually move your original stop loss to all the way up here, okay, below support. Your second buy position, which was here, would now be moved up to another level of support, say here. So now, if you look, both positions are in profit, both positions have a stop loss that's in profit. So if worse comes to worse now, say a big news release comes out tomorrow, the market completely crashes, you've still locked in, as your first stop loss was here, you've still locked in, that's 757 points. Your second stop loss would have locked in 380 points. So now with position 1 and position 2 stop losses in profit, you have no risk, and your reward at the moment is 1,100 pips. So when you see this engulfing bar pattern, you would of course again buy, because an engulfing bar is a reversal pattern. In this case it's a bullish, it's a buy pattern. You can see price move up again, but it's only a small move. It retraces back to around the same sort of level, does the same and does the same again, performs this double bottom down here. So that would have been your next buy pattern. You would have bought, and the next retrace would have been up here. When you got to up here, you would move your stop losses again, and this time you can move your stop losses to here. So now buy position 1 and buy position 2 both have a stop loss up here. Price is up here, and you've locked in probably close to around 1,600 points. So now, as I said, even if worst comes to worst, if some economic data comes out, the market crashes and goes against you, you've still locked in around 1,400 to 1,600 points. You currently have 3 open positions, all of which would be in profit, and your risk at this time would be absolutely nothing. You can see once again that price breaks high after we had this consolidation here. Price broke upwards yet again. On seeing this reversal pattern, of course, again we would buy here, and then once price came up, hit this level up here, and you got the reversal, you would again wait, retrace out, wait till it comes back down again. You again get this buy signal, you get a pin bar, nearly an inside bar, but it did in fact break higher, and then this massive push higher again. So when you got to this level, you would take this buy, the 2 buys down here, and move all of the stop losses up to around this level. Once price did actually move up, you would move your stop loss to this level. So now you have 4 open positions. The risk would have been probably about 40 pips at this point. So in this particular trade and in this particular trend, the only point you actually would have been risking anything is now, and that would have been just 40 points out of probably around 2,000 points you would have locked in by now. And this obviously continues. You can keep on doing this until eventually all your stops would have been moved to somewhere like this level here, and then price would have eventually reversed and you would have got all your positions stopped out, but they all have been stopped out in profit. You may have lost one trade, you may have lost sort of around 50 points of one trade, but you still would have locked in probably closer to 2.5, maybe 3,000 points. So I'm just going to clarify once more. It's not a very easy thing to explain. Buying down here would have got you into the trend. You would have came up to here, you would have seen a retrace, and you would have bought again, and then you would have moved your first position stop loss to break even, so now there's 0 risk on that trade. You would have waited for a break up until it hits a level of resistance again, wait till it comes down to support. Once it hits support, you know that price is going to hold, so now you move position 1 stop loss to either break even or in profit, depending on the size of the trend. Because this one was so large, you would have been quite safe to move your stop loss into profit rather than just putting it to break even. Your second entry would be moved to the same point, which would also be in profit. You do the same again. You would buy here, you would wait for the market to come up. Your stop loss would have been around here. The market comes up, comes down, you see a buy signal, and now the stop loss for that position comes up to the lower support, and the 2 stop losses from the other position come up to support. So as the market keeps moving up in your direction, you keep on reeling in your stop losses till eventually, once we get to the top, the market does come against you and you get stopped out. Now the reason you wait to get stopped out rather than trying to guess where the top is and thinking that the market is going to come against you, you wait to get stopped out because of exactly this. You can see patterns all over the place, these reversal patterns that may make you think it's time to get out of the market, when in fact it's not. You still had a good couple of 100 points. That's actually 1,100 points, so you still would have had quite a bit to go. And if you had seen a reversal pattern, then it may have sort of forced you to go out on an emotion-based decision. So the ideal way to trade this is to actually wait until you get stopped out. Keep reeling in your stops, keep managing your trade until the point where the market does go against you, and then once you're stopped out, you just simply stay out of the trade. As long as you do it well and as long as you do it properly, you would have locked in a large amount of profits, even if it's only a small trend, because of the fact that you end up with 4 or 5 positions with 0 risk, so you can sort of trade more and more lots as you reel in your risk, as long as you only ever risk 2 trades. If you're in a decent trend, then there's no reason why you should ever have to risk more than that when you're using this technique, because if you use the signals and the price action given to you, you can see when the market creates a new floor, and you can simply use them levels to just reel in your stop loss as the price moves up. Now, if anyone has any questions on this video, you can email me at sam@puretechnicals.com, or you can message me on Facebook. My name is Sam Broy. I know it's not a very easy thing to understand, especially in the beginning, so any questions you do have, just send them to that and I'll get back to you as soon as possible. Thanks very much for watching, and I look forward to seeing you next time.